1. Prospect theory. The psychological basis of this behavior lies in prospect theory, developed in 1979 by Daniel Kahneman and Amos Tversky. The essence of the theory. People avoid risk when faced with gains. They seek risk when faced with losses. In other words, when in profit, "Oh no, I hope this profit doesn't disappear," we sell immediately. When in loss, "Maybe it will turn around," we wait, and sometimes even increase our holdings. Because psychologically, the pain of loss is approximately twice as strong as the happiness of gain. 2. Loss avoidance. Studies show that the pain of losing $1,000 is more intense than the pleasure of gaining $1,000. Therefore, realizing the loss equals confirming the pain. Waiting equals buying hope. The investor mind whispers, "If I sell, I will truly have lost. If I wait, I haven't lost yet." However, the market doesn't care about your purchase price. 3. Reference point fallacy. The human mind uses the purchase price as a reference point. For example, the stock you bought for $100 has fallen to $80. Your brain sees the distance to 100, not 80. This is called mental accounting in financial literature. The concept was developed by Richard Thaler. The real question is, would I buy this asset from scratch today? But investors often don't ask this question. 4. Ego and the need to be right. Closing a losing position means saying, "I was wrong." This also damages the ego. Therefore, instead of realizing the loss, the investor blames the timing, blames the market, waits. When in profit, the ego is already satisfied. "See, I made the right decision." And they sell early. 5. Illusion of control. The investor thinks they are in control by waiting. In reality, waiting is often passivity, but mentally it feels like active struggle. This is known as the illusion of control. 6. Social proof and herd behavior. Losing assets are generally supported by narratives such as, "A good company in the long term. Everyone is holding it. Analysts have raised their targets." This legitimizes waiting. 7. Neurobiological dimension. In the brain, profit increased dopamine. Loss pain centers are activated. MRI studies have observed that financial losses trigger physical pain centers. So losing money is not just a financial experience, but also a biological one. What do the studies say? Numerous market data show the following. Winning stocks sold early generally continue to rise. Losing stocks held on to generally underperform. This behavior reduces the overall portfolio return. Even professional investors can fall into this trap. What is the result of this behavior? A portfolio is formed that includes small profits, large losses, low compound interest, high stress. Long-term wealth growth slows down. So what's the solution? 1. Set rules beforehand. Determine your selling criteria when buying. Create a clear system, such as, "I'll exit if it." 2. Forget your purchase price. The market doesn't know your history. 3. Ask the expected return question. If I had cash today, would I buy this again? If the answer is no, waiting may be irrational. 4. Automation. Passive fund strategies reduce this psychological fallacy. The real truth. The human brain didn't evolve for investing. It wants to secure profit. It wants to deny loss. But wealth usually goes to those who can do the opposite. Those who patiently carry the winnings. Those who disciplinedly cut the losing ones.